What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are recapping what just happened in the Fed last week and in the stock market. And there's so many things to talk about here. So we're going to break it down. Basically, a wild week that happened in the markets, in the economy overall. So if you're excited for today's video, or just curious to hear how we can look at these kind of data points, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. We had a lot of data that came out, and the first major one, we also had earnings. We're not even talking about earnings in this video because it'd be way too long. We first start off with getting a GDP number for Q2. Now, again, your GDP number talks about how the economy is growing overall. Estimates were about 2.4 to 2.5% GDP, and the morning of Wednesday, we got a GDP of 3. As you see here, a 3.0% change in the gross domestic product. Again, how much it has changed, which means that it's a good sign, because if it's negative, it means the economy is slowing. If it's positive, it means that it is actually gaining, right? So we went from a negative 0.5 decrease in quarter one up to a positive 3.2 or 3.0 in quarter two. You're thinking, Fridge, that's amazing. Well, yes. I mean, and the idea, we made a video about this before, is that we were hoping to see a positive GDP. I would have been shocked if we had another negative GDP. Because again, the GDP was negative from quarter one because of all the heavily importing of materials, supplies from all these big companies because of tariff fears. So a lot of companies did a lot of importing, and importing is what brings down your GDP. What you will notice is that you take a look at the GDP breakdown for quarter two here, is that a lot of the imports brought up that GDP value here. So again, if you look at quarter one, it was a lot lower. It was down the negatives. It was bringing down that GDP. Now it's the other side of it. We're getting a huge increase in GDP because imports were so limited. You don't need to have a lot of imports because everybody already front-loaded those supplies quarter one. So now they're sitting on a bunch of inventory as the tariffs unfold, right? And so that's kind of what happened here. So you take a look at Wednesday morning, this number came out, and I was like, okay, I was pretty happy about it. But we're just getting started here, okay? And again, beside the fact of all these data points here, we had Amazon earnings, we had Apple earnings, we had Reddit earnings, we had a lot of big company earnings that were this week. We had Microsoft, I believe, was on Wednesday. We had Meta that was on Wednesday. Like, there's a lot of major companies that were going to move markets overall, and they did. You know, Meta had a good beat on their earnings. They were up 11-12% at some point. Microsoft is up like 5%, I believe, at one point after their earnings beat in their, and what they produce and stuff like that. Apple beat, Amazon beat, but the market just wasn't having it. And we're going to talk about why. So GDP came in really good. I was excited to see that. I was like, okay, good. If this number came in super low for GDP for Q2, that's going to be a problem, because that means you get a really big pull down. We were expecting that huge value because of imports. So then we get to the FOMC meeting on Wednesday. Now, it's a 2-day event. It starts Tuesday, and then it goes into Wednesday. And Wednesday is where we talk about the Fed decision for interest rates and everything else. And then they answer questions and everything that happens behind the scenes to that. So we're going to be talking about what's going on here. There's a little bit of a recap from Yahoo Finance. I don't want to go anything too crazy into it here. At the Fed's policy meeting on Wednesday, Powell didn't explicitly say the next move would be to do a rate cut, and reiterated that it's still early days in understanding how tariffs will impact inflation, right? So we don't know about what's going on with rate cuts here right now. And the fear that Jerome Powell has, and the entire Fed, it's not just Jerome Powell, it is everybody at the Fed. But the big problem that we're facing right now is that they can't cut rates yet because they don't know what tariffs are going to have for inflationary values, right? CPI came in a little bit higher than before, which means that there's an uptick in CPI, which is your consumer price index, which is what people are paying and how they're spending and stuff like that. We have all these, inflationary data points we're looking at that's kind of showing a little bit of an increase in inflation. Not a huge one, but even just a little bit of a small increase is what allows the Fed to say we can't cut rates right now. The reason why we can't cut rates right now at the moment of this time here, which is on Wednesday, the idea behind it was that if you cut rates, the focus is to stimulate the economy. That's usually what rate cuts are for. When we go into recessionary periods, when we go into, a high unemployment value, whatever the case is, rate cuts are there to help stimulate the economy. The reason is because it allows you to borrow money cheaper, which then you can then use to expand your company, hire more workers, and it starts to boost the employment rates and the spending in the economy, and it starts to pump the economy back up. That's what rate cuts are usually designed to do. But again, it's to stimulate the economy and to push it out of maybe a potential recession. That's usually what happens for a lot of rate cuts here, or to potentially hopefully avoid that recessionary period potentially. And right now, as if we see this uptick in inflation already because of tariffs, cutting rates allows people to spend more money and then borrow money cheaper, then put it back into the economy again. It's going to just pump more money into the economy, which is good, but it's also going to pump prices even higher. So if tariffs are causing this inflationary prices to go up, you're also going to see rate cuts do the same things. They're push inflation higher as well. So Jerome Powell says it's too early to understand how much of an impact tariffs will have first. Once they understand tariff implication on and inflation, then they can start talking about doing rate cuts. Now, the markets flashed red following his commentary, and the Fed watch tool, which we'll look at in a minute, showed the likelihood of a cut in September dropping from 65 to 45%. Because Jerome Powell is like, hey, we're going to sit here and still wait. And more and more you see and hear that we're going to sit back and wait on more data points, the less confident the market is to price in for a rate cut. That's usually what happens, right? I mean, we didn't get any good indication from it. We actually got kind of the opposite, which is kind of bizarre. Fed policymakers don't make rate decisions ahead of time, so Powell's response is typical, but a quirk in the Fed's calendar raises the stakes for the September meeting. So being on the lookout for that obviously is going to make a difference. This talks more about what inflation is going to be and stuff like that. There was one thing here that was very, very interesting. We do have some level of certainty, however. Powell indicated to some extent that Fed has already chosen to look through the inflationary effect of tariffs as a one-time event. And this is a very important thing to keep in mind about. Usually when people talk about how tariffs are very transitory and they don't do much and it's going to be just a one-time thing as a result, the textbook idea behind it is that you put tariffs in place and then you just let it happen and just roll it out. You just let tariffs hit. Hey, here's tariffs. Boom, they start this day here. We absorb the impact of that, however it is, whether it's consumers, retailers, the markets, they all absorb it, and then we move on, right? It's usually what happens. This time is different, though, because what's happening here is that he's not just putting tariffs out now. He's rolling them out, then taking them back, then putting a little bit more on, then taking a little bit back. Like, you're causing this confusion because we don't really know what's happening with tariffs. Are they on? Are they off? Are we higher than expected? Are we lower than what he's talking about? And that's not the textbook definition of putting tariffs in, and as to how it's a one-time event. This is not a one-time event anymore because of how it's being rolled out. If the administration just came out and just said, here's tariffs, they start April 1st, or they start May 1st, whatever the case is, yeah, we take a huge hit here for sure, but then we could say it's going to be a one-time thing and we're going to move on. But the fact that it keeps flip-flopping, it just makes it that much more complicated for the Fed to understand what's going on and the impacts of it, for businesses to know what's going on, because the businesses aren't really sure about if they should be hiring right now. We'll talk about that a little bit later on. We don't really quite know, and that's the huge problem that we're facing right now. The Fed, he reminded everyone in a not so comforting way, they could have raised rates to counteract the pricing pressures of the new levies. So he's saying that, hey, be grateful, guys, that we didn't raise the interest rates here. Like, what? Everyone's sitting there, he's going to be sitting there getting ready for a September rate cut. The data's been like, okay, we're getting ready for a September rate cut. We'll get one, just kind of see what happens here. And this dude's out here saying, and I quote, we could have raised rates on you. And could you imagine, again, and it makes sense because, again, think about it. If you raise the rates here, it's going to reduce spending power in the economy because inflation is starting to uptick again. Very, very interesting words that he used there. However, a long enough wait could result in a different outlook, as Powell himself acknowledged. We're going to be looking at a lot of data in the next cycle. This is what he always says. I feel like it is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us. Amazing. Other data ahead, Powell noted that he's especially keeping his eye on the unemployment rate, as both supply and demands for jobs have declined, deprioritizing the headline monthly jobs gain. But if the unemployment rate starts to rise, that's a good indicator that the central bank has kept up its slightly restrictive posture for too long. And again, when we look at the unemployment rate and see how it does as a result. We'll talk about that a little bit more as well. But he also suggested the fight to curb inflation is most of the way back. We already have 2 dissenters on the rate-setting committee who believe the Fed should already be cutting. So now there's 2 people who are against that. We made a video about that earlier. It was Waller and Michelle Bowman who talked about that as well. So it's like, okay, sure. So now, okay, so that happened, right? And again, so the interest rate prediction went from 65% Tuesday to 45% Wednesday. Very unlikely to happen. Then this happens. We get a poor jobs report on Friday. Poor jobs report comes in on Friday. We had a larger than normal downward revision here. So let's take a look at what we talk about here now. Now we're getting into Friday, right? So this news drops. Friday morning, 8:30, this news comes out. Also on top of that, there's tariffs that came out again for Trump on Thursday evening, I believe, which already put the market down red for the morning. And then the jobs data comes out, doesn't feel it at all. The latest monthly jobs report showed that the U.S. labor market added fewer jobs than expected in July. Again, the major thing Powell has been talking about for the longest time in these when he's testifying, I should say, is that the labor market is still going strong. And we've been saying this before, that when the labor market rolls over, that is where this is going to be a problem. And now we are starting to see the cracks in the data. The labor market added fewer jobs than expected in July, while the unemployment rate moved higher, just like Jerome Powell said to look at on Wednesday. And revisions to the prior month's numbers revealed significantly fewer jobs have been added than initially thought. So how the idea behind revisions works is, again, the data that comes in, it's not going to be the most accurate data. Some data comes in later, some data comes in at different times, depending on who you're surveying, stuff like that. So they revise data as it becomes more and more transparent, right? As more and more data comes through, they'd say, hey, we initially had this one. Again, it's called the initial jobless claims. We initially had this value right here, but then we can revise it later on when we get more and more data points that come with it. So the U.S. economy added 73,000 non-farm payrolls in July, less than 104,000 for economists. Big miss, obviously. The unemployment rate moved up from 4.2 to 4.1 from the month prior, in line with expectations. Even though it's in line with expectations, there's your data point of saying that unemployment is starting to slowly increase. And think about why unemployment is doing that. There's a couple of reasons as to why unemployment maybe starts to increase, right? One major thing to think about is these tariff implications. These tariff implications are having these businesses at a standstill. They don't know what it's going to do to their prices still. Some of them might have a better indication, but a lot of them are still kind of in nowhere's land right now, and they're not really quite sure as to what this means. So they don't know whether to hire. They don't know whether to lay off people. They don't know when to cut positions. Some companies are already starting to lay off their workforce. Intel announced they're going to do a 15% layoff, I believe, between now and the end of the year to help reduce their margin costs and stuff like that. So if hiring is slowing down, that's going to be your big indication that the economy is slowing down. That's your labor market crack that you're seeing here. And when the hiring slows down, unemployment goes up. We're at 4.2% from 4.1 the month prior. Historically, not crazy, but still a data point that is very important to know. In the release, the BLS said downward revisions to May and June jobs were larger than normal. So not only were they revisions, but they were larger than expected. We always expect there to be revisions because the data becomes more clear, but they had some huge revisions here. With those changes showing more than 250,000 fewer jobs that were added to the economy over these months. May jobs were revised down to 19,000 from 144,000. That is a huge revision. It's not 144 to 110. Okay, we were a little bit higher than expected. We were way off with this. Well, June's numbers also didn't help. It wasn't a one-off in May. June also went from 147 down to 14,000 jobs that were actually created in June as the data came out. The Fed's job report was much weaker than expected and raises the odds of a Fed rate cut in September. And oh boy, did it do that. Remember, the article on Wednesday said 65 to 45% of a rate cut in September. Look at what we have now. 80% rate cut potential probability in September 17th at the next Fed meeting. 80% chance of a rate cut, 20% chance of it staying where it's at. That is a huge move in the markets there. And people are saying, oh my God, it's so good that we have rate cuts, stuff like that. Remember, rate cuts are used to help stimulate the economy. They're not really a bullish indicator as to what a lot of people might think. It doesn't just make the stock market rally again to all-time highs again. It's because we're in trouble and we're trying to hopefully slow down, this economy slowing process here. We're trying to revamp it a little bit. rate cuts aren't necessarily bullish for the economy overall, especially when you get a jobs data report like this that comes out. Again, here's your unemployment ticking up here. Here's your job. And again, as you can see, right, this is a very easy thing to see. From January 2023 to July of 2025, you can see a decreasing trend here. It's not a straight down decrease. There's obviously some higher and some lower, but it is on a downward trend for monthly jobs added. And unemployment is on a upward trend here. So jobs are going down, unemployment's going up. That is showing a crack in the labor market here. So as we're taking a look at this data here, it's absolutely crazy to take a look at that. We have unemployment starting to tick up again. We're starting to see those cracks in the labor market here. Again, also talking more about this article, average hourly earnings in July rose 3.9% of the past year, 0.3% over the prior month. That's kind of what they were looking at here. Meanwhile, the labor force participation rate fell to 62.2% from 62.3%. So participation is also lower, which again is a little bit interesting, to think about. Again, there's another crack in the data here, right? The latest labor market data was released just 2 days after the Fed Reserve opted to hold rates steady at its July meeting. Fed Chair Jerome Powell described the labor market as solid and pointed to a historically low unemployment rate as a key metric to watch when assessing the health of the picture in America. Powell admitted job creation has shown slowing. Yes, it has. But that has come with a decrease in labor supply due to less immigration, therefore keeping the broad labor market picture in balance. And we talk about that obviously a little bit more, again, saying that the job creation is slowing, but it also comes with a decrease in labor supply due to all that. We'll talk about more about that unemployment idea here. Another thing to keep in mind about is that this right here is from the Federal Reserve Bank of St. Louis. The number of unemployed for 27 weeks or over has had this huge increase ever since. Again, over the last couple of months, from May to June to July, we've had this constant uptick into the number of unemployed. So the people that are unemployed for 27 weeks, not only are they unemployed, but now they are starting to stay unemployed here. And again, that could be because of a less demand for labor, like Jerome Powell was stating. Also, AI makes a huge part in this, right? If I can just program an AI to do the same thing for somebody else, I don't need to hire that worker. I can save costs as a result of it. So now we have people in the labor force that are fighting the AI trends now and having to basically go against AI and say, hey, I'm more valuable for this reason compared to artificial intelligence. So things keep in mind about as AI keeps progressing and the jobs data starts to weaken, it might take longer than anticipated for the labor market to start to increase again. The reason being is that AI is going to be taking these jobs over. You don't need to jump back into hiring people so quick. It's going to take some more time. So very interesting labor market data that we're looking at here as a result. And not only that, again, taking a look at the beverage curve that we talk about here. Again, this is your normal curve that we're looking at right here. And I believe if you take a look and see where we're at right now, as of June of 2025, job openings rate 4.4%, unemployment rate 4.1%. This is, again, 2 months ago. They don't have it for July yet. And the thing to keep in mind about, again, is that your normal curve is over here. Either you have high openings and low unemployment, or you have high unemployment and low openings. That's usually how this curve works. And we're out here. So these data points that you all will see over here, which we've been sitting at for a while now, you either have to create more openings or unemployment has to go higher to normalize the beverage curve. And the more likely one is, which we said before, you're going to see a normalization of the beverage curve. It's probably going to be unemployment moving higher, not more job creations, because again, they talk about how there's less demand for labor. So you can't really create a lot of jobs if there's less demand for labor in the labor force, right? So you have to basically, to normalize the beverage curve, you will have a higher unemployment, most likely as a result. Now, this data comes out and it's crazy. And then as this data comes out here, we get two also news articles that come out after that. Trump fires his labor statistics boss hours after the release of the weak jobs report. Without evidence, according to NBC at least, Trump called the data rigged and implied the BLS commissioner, Erica, can't say her last name, manipulated the numbers for political purposes. Like, this is hours after the data came out. Like, this is crazy. Like, don't even give it a weekend to look into it. Just boom, couple hours, we're hitting it, right? Donald Trump on Friday ordered the firing of the head of the Bureau of Labor Statistics hours after a stunning government report shows that hiring has slowed down significantly over the past 3 months. Referring to those were job revisions data points coming in a lot lower than anticipated. Those revisions were so much lower, which is crazy. Talking to True Social, he attacked her. Again, Erica, the commissioner of the BLS, he claimed the country's job reports are being produced by Biden appointee and ordered his admission to terminate her. We need accurate jobs numbers, he wrote. She will be replaced with someone much more competent and qualified. Important numbers like this must be fair and accurate. They can't be manipulated for political purposes. Absolutely crazy. Again, talking about how it's rigged and the revisions and the labor market obviously is starting to have these falters. All this kind of stuff is absolutely crazy. And then not only do we have Trump coming out and saying he's going to fire the BLS commissioner, we have a Fed governor who resigns also the same day, opening a spot for a Trump appointee. And here's the thing that, again, we're trying to make sure that we're trying to avoid here. And we've made videos about this over and over again. The more involved politics will get with Fed decision-making, the worse it could be for the economy. We saw it in the 1970s with President Nixon. We saw it, how that's what he did. He got really involved in interest rate decisions from the Fed. Fed lost credibility. We had sky-high inflationary pressures as a result of it. And then it took Paul Volcker coming in and jacking up rates to then cool off this hyperinflation that we hit in the 1970s. And I don't like seeing that this is a potential. A Fed governor resigning, opening a spot for a Trump appointee. You also have Trump who wants to put somebody else in the BLS commissioner seat to also not fudge the numbers here. It's too much politics being involved in these kind of data points that are very, very crucial. You want to keep things as independent. Obviously, the BLS is a little bit different than the Fed, obviously, but it's just things to consider that, like, if we start just replacing people with just who he wants and starts getting rid of people, it could be a problem. I'm not saying it is, maybe it won't be, but it just creates this fear in the market. Hence why the markets were down on Friday, because all these things are coming out. So again, a member of the Fed's Reserve Board of Governors announced Friday that she'll be resigning several months before the end of her term, handing President Donald Trump an early opportunity to fill a key vacancy. Fed Governor Adriana Kugler is stepping down from her role effective August 8th. She's appointed by Joe Biden in 2023, and her term is going to end January 2026. And again, as we know, Jerome Powell and Trump have been beefing nonstop about all this kind of crazy stuff going on. After I made the last video about the beef happening, Trump went over to see the new renovations at the headquarters with Jerome Powell, and they were having a little bit of beef back and forth there. Like, absolutely just wild, wild stuff here. Trump claimed to reporters on Friday that Kugler was resigning because of the Fed's stance on interest rates. I understand it was over the fact that she disagreed with somebody from her party. She disagreed with too late on the interest rate, obviously Jerome Powell, on that kind of result. Trump did not offer any evidence to back his claim because it seems like there's just a bunch of claims being made here. Some people are starting to come up with the theory that she was paid off to step down to give somebody that appointee for Donald Trump. Obviously, who really knows? She was absent from the Fed's latest meeting, which is interesting, in which officials voted to hold borrowing costs steady for a fifth consecutive time. Trump has bashed the Fed for months, as we know. According to the Fed rules, the chair can be chosen only among the current members of the Fed's board. Treasury Secretary Scott Bessent has said the administration is already actively searching for Powell's successor, which everybody's been saying that. Contenders to the top job of the central bank include Bessent himself, Kevin Warsh, a former Fed governor, Christopher Waller, current Fed governor, and Kevin Hassett, the director of the White House Economic Council. Absolutely just crazy stuff here that's going on, and it's absolutely wild. And so again, the market had this big sell-off here, as we saw from all these things coming out. And on top of that, if you didn't think about it this way also, we have margin debts just passing $1 trillion. Everybody, and if you don't know what margin is basically just giving yourself a loan from, your brokerage account to leverage yourself into positions and all kind of stuff like that. And we are at the highest leverage and margin debt that we have, and I want to say ever. Highest goes 5 years on this chart right here, but it was higher than 2021 after we rebounded after the COVID pandemic. So we're at a market that's been hitting all-time highs recently. We are at maxed out margin debt, where everybody's fully looking at having margins, the highest amount of margin debt that we have ever seen. We have jobs data that's awful. We have a Fed governor stepping down. The BLS commissioner is getting fired. All these things are going on here. The stars are just aligning for some disaster to happen. I think the 10-2 yield curve is also at 0.5 something, which is usually what people say is where you're prone to having a huge impact and a huge market reaction, like a black swan event happening, is when it becomes about 0.5 or so. So, like, all these things are lining up to some craziness that's going on right now here. Now, what could happen? Where do we go from here? I mean, Powell could sit back and keep waiting and waiting and waiting, and then that could be too late to cut rates. We could already hit a recessionary period and all that kind of stuff. That's a possibility to happen. One thing that I guess is a hopeful best case scenario that we have right now is that right now, which I didn't know this at the time of recording this, before I recorded this anyways, the tariffs have been in the appeals court and have been being dealt with that as a result. So it has been going through the appeals court right now here, and it seems like it's been being pushed back against from the Department of Justice in the appeals court, which is good. Because here's where I think the best situation is going to be here. And they also reference Richard Nixon, which is hysterical, at least. But the difference here is that Richard Nixon got approval from Congress, whereas he just kind of did whatever he wanted to do. Again, the court's major questions doctrine also holds that Congress must give them the authority for actions like this, which they did back in when it was Richard Nixon, but not here. The thing that I would think would be the best for this market, and I've watched Meet Kevin talk about this as well, same kind of idea, and I love that he gives this perspective here. And I think it makes a lot of sense. The best case scenario for the markets right now is for tariffs to be rejected from the appeals court, and that's it. And not only for it to be rejected from the appeals court and they get taken off, but for it to happen before it's too late in the markets. Because if it goes through the appeals court for the next, 5-6 months, and then they get overthrown and they get kicked out or whatever, the market could have already been, it could have been too late for the labor market. It could have been too late for, inflation and stuff like that. It could have been way too late for it to happen, and it would have all been basically for nothing. If these get thrown out and they get, kicked out and we reject all of them from the Court of Appeals before it's too late for the labor market, we may still have a chance right now in having that as a possibility where we could still get that soft landing that we're looking for in the markets. It's a big if, obviously, but it's something that I think will be a very good possibility that if this does get overturned before it's too late, we could still have a soft landing here and we could still have a good chance to have it where, because again, if you think about what really happened, if tariffs are gone, companies will be like, okay, we have no more tariffs. We start hiring people again, which is good. Hiring people again is going to increase the labor market again, potentially. It might take a little bit of time. It's not going to be like dramatically in a split second. But, once tariffs are off the board, if they are off the board, businesses will be like, okay, we know what to do now. We can start hiring people again. We'll start hiring again. It's going to push the unemployment up. People start getting hired. We start putting more money into the economy. It starts to grow the economy even more again. Like the biggest problem right now, before us getting rate cuts, is these tariffs. If these tariffs weren't in effect, we probably would have gotten at least 1 or 2 rate cuts already up to this point. But with this tariff delaying the rate cuts, it's not like it's Jerome Powell just being that guy and just being like, no, F you kind of thing. It's Trump's idea of putting these tariffs in, but not just putting in tariffs, but putting in these huge tariffs, not just like the standard ones that you might see from his 2018 presidency that he put those tariffs into place. These are a lot bigger. These are a lot more, extreme in the measures. And that's what's causing this uncertainty. And the Fed's like, we can't do anything about it. So very, very wild day in the market here. But that is basically everything that's going on. I don't know what we have for data coming up this week. I got to take a look and see what's going on here. But so things to keep in mind about as to where we're going. I hope a lot of this made a lot of sense. You can make a lot of connections here. It's a longer video, I know, but hopefully it's worth it for you guys. Again, thank you guys so much for watching. If you did make it this far in the video, as always, feel free to like the video, subscribe to the channel, and turn on those bell notifications so you don't miss any future uploads. And as always, I hope you're making money in the market. I hope you're going to be able to be safe through this tough times that we're going to be going through, maybe. Again, only time will tell what's going to happen. I'm hoping for the best, but again, it's always one of those phrases: hope for the best, prepare for the worst. Always puts you in the best situation. Hope you're making money in the market in some way, shape, or form. And as always, guys, I will see you in the next video.